A pullback is going to be inevitable, but from a timing perspective, sentiment still remains staunchly negative. So, I think that the gold standard is the AAII net bulls, less bears. That's been 6 consecutive weeks where it's negative. That's never really marked a market top. I mean, that has to flip positive and sustain for several weeks. So I think if we're going to say between now and year end, could the market pull back? I'd say it's possible, but to me, it's probably from higher levels. I think there was a lot of skepticism about even yesterday's FOMC. I had a lot of clients tell us they thought the stock market would sell off because 25 was priced in, but because almost everyone told me that, that was the consensus view. I think people were cautious into yesterday, and that's why we're seeing the groups that should rally big, like the small caps and the cryptos and the financials and even the Mag 7.
Let's start with the Federal Reserve. Tom Lee emphasizes that the Fed still matters enormously. It remains, in his words, the most powerful institution in the world. For more than 31 months, the ISM Manufacturing Index has been below 50, a signal of contraction. That's created an atmosphere of caution in corporate America, a sense of keeping the car in low gear while waiting to see how inflation and monetary policy play out. Now, Lee argues that when the Fed eventually shifts from tight policy to easing, it won't simply mean lower interest rates.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Tom, what do you make? I mean, how much does the Fed really matter to the equity markets right now?
The Fed still matters a lot because they are the most powerful institution in the world. And it matters because monetary policy, relatively tight, has kept the ISM below 50 for 31 months. And so corporate America has operated with a bit of caution, keeping the car in low gear because they didn't know where inflation was going to be and they didn't know where monetary policy was. So I think when the Fed begins to ease, it's not just a move in interest rates, but it's a green light for corporations to get more confident. And as you know, the ISM moving above 50 does not only revive economic activity, it probably also rejuvenates the labor market, which has been sluggish for what looks like more than 12 months.
So does that mean if the Fed stays dovish or keeps cutting, that there's other newer legs to this pretty remarkable stock rally?
Yes, and I might even say that I think that we could have growth recover without inflationary pressures. I think reflexively, people the last few years think growth picking up means there's automatic inflation. That has not been the case for 25 years. But I think if companies begin to expand, plus the fact that we know AI is driving productivity gains, and that's really a big tailwind for businesses. And then we know that there's initiatives around Wall Street boosting productivity because they're going to build on the blockchain. I think there's a path for growth to be stronger next year without a pickup in inflation. That's going to be very good for profits and for equities.
Yeah, and listen, we've talked about many times, Tom, and I know you've talked about Scott and others as well. You've been long, you've been strong, you've been correct. But is there, at some point, does this market take a breather? It's getting, listen, as a 401k holder, I like it. But as a TV analyst who's been doing this for almost 30 years, I'm starting to worry about it a little bit.
Yes, I mean, a pullback is going to be inevitable. But from a timing perspective, sentiment still remains staunchly negative. So, I think that the gold standard is the AAII net bulls, less bears. That's been 6 consecutive weeks where it's negative. That's never really marked a market top. I mean, that has to flip positive and sustain for several weeks. So I think if we're going to say between now and year end, could the market pull back? I'd say it's possible, but to me, it's probably from higher levels. I think there was a lot of skepticism about even yesterday's FOMC. I had a lot of clients tell us they thought the stock market would sell off because 25 was priced in. But because almost everyone told me that, that was the consensus view. I think people were cautious into yesterday, And that's why we're seeing the groups that should rally big, like the small caps and the cryptos and the financials and even the Mag 7.
We might even get a record high for the Russell 2000 about
to go too much more on interest rates, depending what happens with the economy, it gets into the danger territory. Right now, to go another 25 basis points or another 50 basis points, does it really matter? One way or another, it probably keeps the stock market a little buoyant. You have to be careful because we're, like you said, where the average stock isn't cheap. The big stocks are not cheap.
Guy Adami.
Hello, Brian.
So I won't use the term basis point except to say that I'm not going to say basis point. Let's talk 0.25%, 0.5%. Is David Tepper correct?
First of all, it's great to have you here. I'm sure Tim greeted you last night.
I did, but we can do it again.
Well, why not? Because he's here again.
You're
tonight.
back. You should do it. So.
Hello, Brian.
Hi.
Number two, that's about as dour as you're going to hear David Tepper. So when he has that type of tone, listen, I don't think he's saying you sell everything today or tomorrow, but when he's somewhat cautious, which you really haven't heard him be over the last decade or so, I think you have to take note. And what I think he's speaking to is, the Fed's sort of in the rearview mirror. Another couple cuts are probably not going to move the needle that much, but it's hard finding value right now, and the market has gotten itself expensive. So when I listen to him and I hear the tone in his voice, to me it sounds somewhat cautious for the first time in a while.
Well, he was really balanced, and he talked about a lot of things. He even talked about his politics, and he said he's right up the middle. And that's what I heard in terms of his market view. And what I hear, what I think you're saying, what I think the market did today, when you see all four indices close at all-time highs, but you've got the high growth, very expensive NASDAQ, but maybe you're paid for that growth, finishing, and then small caps rallying. You've got kind of a barbell strategy. You've got people saying that's a glass half full interpretation of the Fed saying, yeah, we're certainly in easing mode, 2, 5, how many cuts, but the economy's not falling apart. Jobless claims today, a volatile data point, but nonetheless showed that jobless claims fell. That gave the market a little more ammunition to say the labor market's not so bad. So my summary on all of this is, sorry, Guy, hold your ears. Yeah, this is Goldilocks. You've got Fed in easy position, and you've got an economy that's not falling apart. Even if stocks are expensive, you're buying equities in that environment.
Yeah, I guess you are, unless yields start going up, right? And so when you think about
which they did today.
Well, they did a little bit. Last year at this time, we had that jumbo cut, 50 basis points. The 10-year was trading at 3.7% or something like that. Went all the way to 5% or so over the next, 3 to 4 months. And so you've seen a big divergence over the last, couple months where the S&P has just kind of blown out to new highs. And you've seen yields on the 10-year go the opposite way. If you start to see yields maybe work their way up to 4.5, where they were just, 2 months ago, that might be cause for the S&P 500, at least investors, to kind of take their foot off the pedal a little bit. And I also say that, we see this rotation in the Mag 7. It happened when we saw Google, when we saw Amazon and the like. Now you're starting to see these names kind of underperform these moves. NVIDIA has never confirmed the new highs in the S&P or the NASDAQ. And we're starting to get kind of, long in the tooth. You take this NVIDIA investment, I know we're going to talk about it later. It feels like we're trying to pull lots of rabbits out of hats. And I'm not saying that is by design. The SOX massively outperforms today for something that is not going to be really relevant to the technology complex for a while, at least 6 months, maybe a year.
One concern is rising bond yields. Last year, the 10-year Treasury yield climbed from 3.7% to 5% in just a few months, creating headwinds for equities. If yields creep higher again, toward 4.5% or beyond, that could put pressure on the S&P 500 and force investors to reassess risk. Another risk is leadership concentration. The so-called Magnificent Seven stocks have driven much of the market's gains, but we're beginning to see rotation. Names like Google and Amazon underperforming, NVIDIA struggling to confirm new highs, and other sectors trying to pick up the slack.
Let me tell you what really interests me here, that Chris Waller did not dissent in favor of 50 basis points. Remember, he is the front runner, or very close to the front runner, to be called chairman. And not being more aggressive here, I'm just wondering how Trump now would look at Waller. Maybe I missed it. Did you hear any tweet from Trump about the Fed's announcement? I know he's in England,
I don't
but
think so.
I did not see anything. So
No,
I
and
think
I was going to say there was the one dissent, which we believe Stephen Myron wanted 125 basis points by the end of, 50 basis points this meeting, and then a good deal more the rest of this year. But there was some thinking ahead of the meeting that, one of the outcomes could be that, Waller and Michelle Bowman, whoever might have wanted a more aggressive move, could kind of get the statement to frame things in such a way where it's just, look, this is sort of a process most likely, and not necessarily have to have the dissent. So I don't know if that means much to the markets in an immediate basis. It basically, rates are tilted lower at a time when the economy still seems to be hanging in there. We're anchoring to the soft labor market data, which is giving you, an impetus to actually try and take out some of that risk management insurance that Powell talked about, and yet not really respond to any kind of economic emergence.
Roger Ferguson said one of the non-voters, something with the dot plots, which indicated
he didn't even want
to cut.
He or she did not even want to cut.
Someone wanted 50, someone wanted nothing. So kind of a fractured.
We don't absolutely know it was a non-voter. You could presume it. Maybe it was just a show of unity, saying, "Hey, we're with the chairman," and Steve Myron is the only one. The recent appointee was the only one that dissented. It could be a show of support for Powell on all the potential dissenters. It's sort of interesting had Myron not been there, the interference had not been there, maybe there would have been some dissents. I thought there were going to be some two-sided dissents, more on 50 and maybe one or two on none. Don't forget, I think that there's 6 or 7 that don't think there should be any more cuts after this year. And one then, of course, said that I think we shouldn't have cut at this particular juncture. But they all united, and then only President Trump's recent nominee was the only dissent here. So it could be it could be kind of a this is the way we work things, and I'm interested to see how Trump will respond and whether Waller moves down, and whether we're going to get several of the others that have been
talk about the markets, Jeremy. Talk about the market, Jeremy. I told Mike that this is in the history of the world. This is today the best time to have ever been in the stock market. I'm just saying because we're going to hit new highs. And Mike pointed out how many did we hit last year? We hit
55 or something.
But none of those new highs were as high as today's new high, Jeremy. So this is as good as market.
Listen, whatever negatives is coming from the tariffs, and they don't appear to be as negative, certainly as we feared at the beginning, are being offset by the positives of the Trump policy, particularly that tax bill. Which was really so favorable to corporate earnings, the deregulation promises, which are, also very, very favorable. By the way, the lower dollar is also very, very favorable to U.S. stocks, since 40% of the profits come from abroad. So, all the negatives from the tariffs are more than offset by the positives that are going on in the market. And so we are up 10%, I think, from when Trump won the election, and at new all-time highs. And listen, at a seasonally weak time, which is the last half of August and all of September, to continue to hit all-time highs is very, very positive, I think, for year-end.
Politics also loom in the background. Discussions around potential Fed chair candidates, Trump's influence, and fiscal policy always stir volatility. But Lee stresses that the fundamentals, corporate earnings, productivity, and liquidity, matter more than political noise. He even echoes a broader point. In the history of markets, there has never been a better time to be invested than today. Corporate tax cuts, deregulation, and a weaker dollar have all boosted earnings power. And with stocks consistently hitting new highs, even in seasonally weak periods like late summer, Lee sees this as confirmation of the market's resilience.